Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Welcome to Supernatural Stocks. Last week was all about trailing earnings versus earnings guidance. And the TLDR there is that because of the high traded multiples on the US market in particular, the market puts a lot of faith in future earnings. Guidance is inevitably extrapolated into a multi-year forecast, which then contributes a much larger percentage of the value of a company than its earnings in the past year or certainly the past quarter. The forecast matters more than the known quantity in this case. Hence, stocks can exhibit big moves based on guidance, and sometimes those moves look quite strange relative to the latest results, because guided percentage growth can be very different to the quarter that just happened. Now, another pretty important concept to understand share price responses and reactions to earnings is the build-up to the news release. This includes things like the range in which a stock has been trading. When a stock comes into earnings release day trading at 52-week highs, it is a very, very different setup to when it is trading at 52-week lows. Both of these are also different to a stock stuck in the middle of a range, ready to jump in either direction. This puts us into the territory of technical analysis, which is how traders ply their, trade. For stocks to make new highs or new lows, there needs to be a strong amount of buying or selling respectively. This is because of the way in which traders and other market participants treat key resistance and support levels, so we need to cover this off. If enough people believe that a resistance level like a 52-week high is going to be difficult to exceed, then they will take profits at that level by selling their stock, and it practically becomes a self-fulfilling prophecy due to the number of sell orders in the market. But if results are great or there's some other positive news, and then there are enough investors and traders who believe that the thing can keep going up and should be higher, you can see a breakout to new highs despite all the selling pressure in the market. The same logic applies to key support levels, just in reverse. If things are bad enough, a price can break below that level and plunge to new depths, even if some traders were putting in buy orders at the key support level in the hope of a bounce. So when you're looking at an earnings calendar or you're thinking about how a stock might behave in relation to the release of results, be sure to understand the chart that sits behind the numbers. Likewise, when you are working backwards and you're reading about how a stock reacted to earnings, it's also important to look at the context to that move. The US market dished up two perfect examples in the past week that show us the extent to which the market can positively react to earnings. Airbnb was the recovery move because the company has been taking some strain. Some of this is purely due to the valuation, with the company trading on a demanding 10 times sales multiple a year ago. That multiple unwound all the way down to 6.8x in the past year, with concerns in the market ranging from regulatory clampdowns in certain cities through to the way in which Airbnb has been prioritizing its hosts over the guests, and at times actually making it quite painful to use the service. Despite the unwind in the multiple, the share price was only down around 9% over 12 months because of the underlying growth in sales coming into this quarter. If you zoom out, you'll find a share price chart that has been quite the roller coaster ride. There is no clear momentum in the stock over the long term because the IPO was in December 2020 and Airbnb came onto the market with a red-hot valuation that it has struggled to grow into. Those who got their shares at $68 per share have made a killing, but there were very few in that category. Those who bought the opening price in the IPO of $144 per share, which is way more likely for just normal people like you and I rather than big institutions, they've only come out flat over 4 years because the stock was trading at $141 a share before this earnings release. So don't buy IPOs, kids. That remains the overarching lesson here. Recent pressure on the share price had already started to turn into upward momentum at least. So coming into this result, the market was hoping for a decent fourth quarter. And Airbnb certainly delivered. They had 12% growth in nights and experiences booked. That's their strongest quarterly growth this year. And the market loved it. After hours move, 14% up. This took the share price to $161, which is not too far off the 52-week high of $170. Sticking within that 52-week range is a comfortable level for a share price. So it's not uncommon to see large percentage moves provided they end within that range. Interestingly, this was the case for Airbnb despite pretty modest guidance from the company. So this is now at odds with what we've talked about in the past week. In this example, thanks to there being room for upward movement in the share price because of not just the chart, but also the underlying valuation multiples versus historical averages, the market was actually quite happy to celebrate the results instead of punishing the softer guidance. Had Airbnb come into this release on a more demanding valuation, there's every chance that things could have gone the other way because of the softer guidance. If you are serious about your single stock trading, it helps tremendously to have a platform that can chart things for you, like a price earnings multiple over time or a revenue multiple over time. You can then compare the latest multiple to the historical averages, and this allows you to assess the margin of safety, which also tells you where the market might be focusing. A stock that is trading well ahead of its averages is all about the guidance and the need for growth. A stock trading below its averages is looking for an excuse to revert to the mean, so good news could be strongly rewarded. The second example is Coinbase, and this is more of a momentum move rather than a recovery move. It's also another great example of why you should avoid IPOs as a general rule. When the company came to market in 2021, the IPO opened at $381 a share and went as high as $430 a share. Today, it is trading at $298 a share. So the share price chart basically just looks like this deep valley of despair because there was a huge sell-off as low as $35 a share in late 2022 before a long road back up. Of course, if you bought anywhere in the valley, you are now smiling. It is very unusual to see stuff like this where a company loses almost all its value and then gets almost all of it back. After a strong year of performance in crypto, with Bitcoin up 81% in rands in the past 12 months, and I prefer not to comment on the existence of things like Fartcoin or many others, Coinbase's share price has been on a charge. Although an 8.4% rally in response to this earnings release looks quite tame, especially compared to what we saw at Airbnb, you need to view it in the context of strong recent momentum, and thus there was every chance of the market punishing a disappointing earnings release. Luckily, there was no such disappointment. Trading volume in the quarter was up a rather ridiculous 137%. Subscription and services revenue, that was up 15%, so they are also making decent progress on their annuity revenue ambitions. And the market is paying up for this story once more, with Coinbase on a revenue multiple of 14.9 times. It went as low as 1.45x when the share price collapsed in late 2022. So it really is quite incredible. You will not often see something like this. The sales multiple, interestingly enough, was in the high teens in the months after the IPO. So the current level of 14.9 looks pretty fully valued in terms of that multiple. Of course, what this really means is that if revenue or sales, the basis for that multiple, can keep growing strongly, then if the revenue multiple just stays steady, shareholders can still do well out of this. Now, I am certainly not encouraging you to try and guess how a company's share price will respond based on the release of earnings. That is a very dangerous game to play, especially in the tech sector where you can easily see double-digit percentage moves in a single day. Instead, I'm suggesting that you look back on how the market reacted to earnings and learn from that. What is the key thing to learn? In my opinion, the most important insight relates to risk-reward setups and how much good news or bad news is already priced into a company. I'm also a very strong believer in how the market likes to use comfort zones. Gaps, big share price gaps, those like to close. Ranges are relevant. For a stock to go out of a range up or down is a big deal. Average historical multiples are a really powerful tool, as I've mentioned. My belief is that market emotions and responses to those emotions are more helpful than textbook arguments about what the discounted cash flow valuation might be telling you. The markets are difficult, so why not use every tool available to you to improve your chances of success? Although it is still possible to have success in the market by focusing purely on fundamental concepts and ignoring charts and technicals, it just feels like a much harder way to make money. By looking at fundamental and technical concepts in the market and trying to understand how those emotions play out, I believe that you give yourself the best possible chance to try and make money in the markets. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research, form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.